Good day, friends. My name is Kaira Ahuja, and welcome to the Fund Manager View Show at MK Investment Managers. In today's episode, we have Mr. Manish Sonthalia, Chief Investment Officer at MK Investment Managers, for an insightful conversation on markets, investing, and more. Welcome, Manish, sir.
Thank you.
Hope you're doing great, and so are the markets.
Yeah.
To start with, sir, post-elections, how has the market atmosphere been for the investors?
So I think there was what should I say? There was a left out feeling, post the crash, just after the exit polls, and then a V-shaped recovery in the market. Many investors were left on the sidelines, and the markets have moved up too soon, too fast. And now there is a catch-up. There is a FOMO factor. I would believe that there is a fear of missing out on the market. And what we have seen through the SIP flows, some 35,000 crores worth of flows have come, which actually means that people are waiting to buy the dip. Now that the election verdict was out and people who were sitting on the sidelines had no reason to sit on the sidelines, come into the market. So I think market atmosphere is that of fear of missing out, and you'll see more participation as we progress along.
Right. In your recent interview to CNBC, you expressed a positive action coming in the first 100 days of government formation. Which sectors do you think are poised to benefit in the near term?
So I think before the elections were out, there was already an articulation by the existing government that they'll be very high on the agenda as far as the first 100 days of program would be. I think it is just a continuity of Namo 2.0 into Namo 3.0, and it's the same infrastructure, your Make in India, Atmanirbhar, is the same renewables, it is the same defense. So I think what will be additionally looked at is that since the government has got lesser number of seats than what was anticipated, and there is clear stress in the middle class, the lower middle class, and rural India on account of inflation and unemployment. I think the first 100 days, and we would see the budget also come in between the first 100 days, address the unemployment side of things as well as alleviation measures on the taxation front for the middle class and lower middle class. So on the one hand, it's going to be a continuity from the investment related themes. There is going to be an additional impetus on the consumption related themes. All in all, I think it's going to be a fine balance between these two, that you should likely see announcements between the first 100 days. I mean, that is what we believe should be the thing. I think previous to when we went into the elections, it was all about the investment side of things. Post the elections, once we have seen the numbers in terms of mandate and the fact that many states are going into elections, I think the consumption side of things will also be looked into.
Perfect. What key provisions or changes are you expecting in the upcoming budget that could impact the investment landscape in India?
So first of all, I think there is going to be continuity in terms of the capital gains tax regime. Our Honorable Finance Minister has already articulated that capital gains won't likely be touched. Then, you'll have the GST Council actually meet, not in the budget, but prior to the budget. Inverted duty structures are going to be corrected. Plus, there could be some new sectors like oil and gas, which could come within the purview of the GST. Now, that's going to be a very big thing. It's going to be a game changer, but we don't know as yet. We'll have to watch out these things.
Right.
I think all in all, the focus would be on lowering the burden of taxes on the middle class as far as the budget is concerned. Investments moving into rural India, that's the need of the hour. I think the flagship programs of the government of India, whether it be the Jal Jeevan Nigam mission or the Amrut, the government has taken care of the roti and the kapda side of things, and now would be focusing on the makan side of things. Roti, kapda and makan. If you look at the common man, is these three things which are most important. Is already given or extended food subsidy for the next 5 years to 80 crore people. Cloth is or kapda is not that big a problem. Makan, 3 crore new houses being constructed, so that you feel the common man or the rural folk would have a feel good factor. So I think anything that goes into the housing side of things, whether it be the finance or whether it be the subsidies, these would be likely addressed in the budget. Another thing to watch out for is, as I said, that there's going to be a fine balance between the investment and the consumption side of things. You have to stick to your FRBM numbers, which is the Fiscal Responsibility and the Budget Management Act. You have already articulated, or the government has already articulated, 5.1% as the targeted fiscal deficit for fiscal 25. Because there is going to be an impetus on consumption, or let's say alleviation of the problems of the middle class in the rural India, I don't think they will actually exceed that 5.1%. In fact, given the the dividend that they have got from RBI, this number of fiscal deficit could actually come down to 4.9, and if that happens, I think markets would be pretty happy. Along with that, I think the flagship programs of the government, whether it's the Atmanirbhar, whether it is the Jal Jeevan, the infrastructure, the roads, the defense, the railways, all over, it's just a continuity of all these things will be just intact. So what is to be watched out for is the revenue numbers, which means the tax collection, the fiscal deficit number, the expenditure side of things, and to which areas these are allocated. I think it's going to be a balance between investing and consumption, both sides.
Moving on, what macroeconomic trends are you closely monitoring and how will they influence your investment decisions?
I think the macroeconomic trends seem to be favorable. India does not seem to have too much of a problem in terms of the inflation numbers. Interest rates have peaked. You're not likely to see a further increase in interest rates because inflation is not that big a problem. I think globally also the Federal Reserve has already talked about one cut. I think the markets out there are figuring or putting in place 2 cuts during this calendar year. And once the rate cuts in the US begin, we'll also see rate cuts in India. I think for the full year, fiscal 24, you saw very strong GDP growth of 8.2%. We are likely to see something between 6.5 to 6.75 in terms of real GDP growth. Corporate earnings are not going to be as strong as fiscal 2024, where we saw Nifty 50 actually deliver earnings growth of 24%. But in fiscal 25, earnings growth is likely to be in the vicinity of around 13 to 15% on the Nifty 50. And within that, I think few sectors are likely to be in the limelight. These would be banking, BFSI as a whole. It would be IT, information technology. It would be oil and gas. It would be metals. These are the 4 sectors which are actually going to lead the corporate earnings growth as we move into fiscal 25. So I think and monsoons are likely to be okay. And if you have a policy impetus from the government, then I think there is going to be a multiplier effect in terms of, added to the government balance sheet being spent on infrastructure. You could also see private capex come through and create the multiplier effect on consumption and jobs. So I think broad trends to be seen also in the budget is the spends on health and education, because these are the 2 most important things in terms of creation of employability and income generation, which again will lead to how much of consumption you'll have and so on and so forth. So these are some of the trends that broadly you'll be watching out for. I think the key monitorables would be commodity prices, because we are on a global inflationary, things are not that great as far as the inflation side of things are concerned. Red Sea is a major issue. You're again starting to see supply chain bottlenecks come through in a big way. Containers are getting stuck up in a few ports like Singapore. So free trade is not happening, which is leading to a supply side shock on prices. This could impact the margins. So all of these would be the major trends that you'll be watching out for on the global macro side as well as the domestic macro side.
Right. Our India's Golden Decade of Growth Fund, which we've been managing now, has been founded on 5 broad themes, which is consumption, digitization, financialization of savings, AI, and renewable energy. Which of those will be leading the pack in terms of growth in the next 3 years?
I think all the 5 themes are important, but from the next 3-year point of view, I think it's going to be energy transition. The government has time and again articulated energy. We got to secure our energy if we need to grow at 6.5%. And fossil fuels giving way to renewables. So that is one area which will clear. And the entire value chain in the power sector is likely to do quite well. The second is obviously consumption. We are likely to see a pickup in consumption within the next 3 years thanks to policy initiatives and the increase in per capita income, both rural and urban. Urban has been leading, rural has been lagging. We expect that rural income and rural consumption likely to pick up in the next 3 years. And obviously, you would have India manufacturing, Atmanirbhar, defense, railways, China, PLI, all of that, would be in the limelight. So these would be the 3 broad themes. And I think over a period of time, you'll also see financialization. It's a continuing factor. Not that the other 2 themes are not important. In fact, over a period of time, they could be much bigger. And AI, obviously, second half of this year, you should likely see even IT, start to pick up.
In continuation to what you've been mentioning, IT has been rather subdued in the recent times. So are we saying AI will be able to bring back the growth wave?
So AI is something which is happening right before us. It's not that it's going to happen after a point in time or has it already begun. It's a continuing thing.
Right.
I think the key thing to watch out for is how much of an increase in productivity happens due to artificial intelligence in the business model of companies, and what the customers of these IT companies are willing to pay for the increase in productivity. That is an evolving situation over a period of time. Efficiency will go up, but how much of that efficiency will get into billable hours, because you are substituting labor with machine hours. So I think number of people are going to be less, but productivity is going to increase, and that would mean that your billing rate, etc., should go up. So that's an evolving situation. In terms of the turnover of IT companies, I think the order books are very full, but due to macro headwinds in the developed parts of the world, primarily the United States, we had a slow execution. This execution is likely to pick up in the second half of this year and going into the next year. So I think somewhere down the line you'll see the bottoming of even IT as a whole, and companies which incorporate artificial intelligence should see pick up in their overall margin numbers, assuming that billing rates do go up even after a point in time.
Right. Moving on, sir, with rising income levels which are powering the consumption habits, which subsectors do you see leading the pack in years to come?
See, I'm more positive on the discretionary names, and that's an unequivocal statement. There are certain segments of the market we believe that FMCG or consumer staples are likely to do better because things have not been that great for the last 2 years for this space. But my only point of contention is that you don't suddenly start increase the use of soap or toothpaste etc. Right? Because these are very penetrated categories. They are already available in 95% of the total country, and there's only, the growth happens only minuscule over a period of time. So I think the big story in FMCG could be premiumization, but that's a very long-term story, and there's nothing much left on the table as far as near-term valuations are concerned. So if there is an increase in income, I think that's going to get spent more on discretionary. Your motorcycles or your air conditioners or your travel and leisure, your airline travel is likely to go up, entertainment, movie tickets and all of that. This is the side of thing which is going to see more growth as opposed to the soap and oil and toothpaste and all of that. So this side of consumption is where I'm more positive about. And obviously in the India's golden decade of growth story, the built up of the per capita income will mean that discretionary spends are only going to go up. Many more categories will get included or will find their presence in the discretionary spend. You'll spend more on hospitals or medical, you'll have better healthcare as one of the areas of spend, or your cars are going to be more electric than ICE because you need premiumization and all of that. So discretionary side is likely to do much better than, and even on the rural side of the economy, people are quite aspiring to upgrade themselves. It's not that they are just restricted to your consumer staples. So out there also, I think it's high time that rural India starts to spend on discretionary rather than staples.
Right. That was rather insightful, sir. But now I will move on to our fun segment, which is the rapid fire round. So, one sentence or one word that comes to your mind in terms of auto.
Two-wheelers better than four-wheelers.
Specialty chemicals.
Somewhere close to the bottom.
Infrastructure.
Continuing story.
Defense.
Overvalued in the near term.
IT.
Likely pick up in the second half of this fiscal.
Oil and gas.
Sunrise sector for fiscal 25, I think. It will lead the charge in terms of earnings growth.
Power.
A big opportunity for the next 5-10 years.
FMCG.
So story.
And lastly, capital goods.
I mean, again out here, near-term valuations are demanding. It's it's mostly priced in to perfection for the next 5 years.
Perfect. Thank you so much for being on the show today, Mr. Sonthalia. And thank you, viewers, for watching.